there, everyone, and welcome to the Final Bar. It's Wednesday, July 24th. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a beautifully sunny Redmond, Washington. Thanks for joining us every weekday after the close, especially on a day like today where the market forces really pushing to the downside. We've talked about what I've been terming the great rotation of 2024, and I know a lot of others have implied this rotational environment that we experience. Today, sort of an exclamation point on that particular phenomenon, and I would say today was even less about rotation and more about just a lot of things going down. We have the NASDAQ down over 3.5%, the S&P down over 2%, even small caps, which have been a bright spot, down almost 2% today using the S&P 600. So today, very much a risk-off day that comes after Tesla and Alphabet, both with some disappointment on the earnings side, especially Tesla, down over 10% today. So a lot of move to the downside. And what's interesting is this is following some of the traditional seasonal patterns we've been talking about. Is it going to be that easy, right? With a strong July into a weaker August and September? Maybe. But let's look at the charts and see how the evidence actually played out as we get to our market recap today. You know, looking at the major averages, you can see the S&P 500 down over 2%, finishing the day around 54.27. Now, we gapped down at the open and just really finished lower through the course of the day today. Today was not one of those choppy, volatile, uncertain what the general trend is kind of days. This is one of those when the sports team just needs to get to halftime or we just need the clock to run out so we can all go to our locker rooms and reset. That is what the market was doing today. The NASDAQ composite down almost 4%. It's down about 3.6%. Same for the NASDAQ 100. And again, I mean, no real relief to the downtrend through the course of the day today. Mid caps and small caps a little better in the first half of the day. Around midday Eastern, small caps are actually flat for the day. The afternoon really turned into an everything sell-off kind of environment, with mid caps and small caps both down almost 2%. The only green on the front page here is the VIX, which pushed upwards through the course of the day. Now, yesterday, the VIX finished the day just below 15. As I've reminded you, VIX below 15 is a low volatility, kind of not much to worry about type of environment. VIX over 15 is a concerning environment because that tells you elevated uncertainty, elevated fear, and usually an elevated risk of further downside for stocks. The VIX finished today above 18. This is one of those where I feel like if the market closed at 6 p.m., we probably would have gotten to 19 or 20 with how things were going, but we'll cut it off there. We'll see if the markets are able to reset and find their footing. Would not be surprised if tomorrow is a bit of an upside rebound day. After you have a big sell-off day, you often get a nice rebound day the next day, but we'll see. Certainly the general trend for today's session was to the downside. Bond prices were down as well. So this is one of those days where stocks and bonds both finished lower. The 10-year yield was sort of holding steady around, we'll call it 4.25%, but in the afternoon really pushed higher as bonds sold off again. In the afternoon, kind of everything started to rotate lower. So the 10-year yield finishing the day just below 4.3%. The long bond yield around 4.55. And overall, those are both higher than we were at the day yesterday. Dollar index, no real concerning move at this point. I would say the dollar index ended up finishing kind of flat for the day. It's using the UUP, which popped higher in the afternoon session. Gold and silver all down as well. Now, earlier in the day, gold was positive. This is kind of how the day unfolded. The first half, stocks selling off, other things starting to work. As the afternoon progressed, sort of dragged everything down with it. There were a couple pockets of the commodity space, particularly crude oil prices, that remained slightly positive, but overall, quite a bit of damage here. Kind of a noisy session for cryptocurrencies. Bitcoin basically flat from yesterday, currently just below 66,000. Ether prices just below 3,400. That is down from yesterday's close. Looking at the 11 S&P sectors, you can see utilities, healthcare, and energy. Those are your three managing to finish in the green on a big red day. That's utilities up 1.2%, healthcare up 0.9%, energy and consumer staples basically flat from yesterday's close. The big deterioration was at the bottom of the list. Your FANG sectors, technology down over 4%, consumer discretionary down over 4%, communication services down over 2.5%. So Obviously, these are cap-weighted ETFs. They're dominated by the biggest names. So when Tesla's down 12+%, the XLY is going to have a pretty tough day of it because it's such a big weighting, and Amazon down as well. So that's certainly hurting things in big tech, struggling quite a bit. Semiconductors, software, hardware, all finishing in the red today. We'll get to some of the market carnage on individual stocks here in a little bit. But I do want to highlight with the Magnificent Seven and Friends, our mega cap growth leadership names. Let's see how they played out through the course of the day today. Not great. You can see, actually, let me resort this. Netflix down only 1%, and that was the brightest spot out of them all. Then next was Apple and Amazon down about 3%. On the downside, you have Tesla down over 12%, NVIDIA down over 6.5%, and so forth. You know, one of the charts that I showed earlier, I had a webcast on small cap stocks. Hopefully some of you were able to join me for that one. And if you missed it, I mean, one of the charts we talked about was just the dominance of the Magnificent Seven, a theme we've talked about quite some bit. What I want to show here is coming off of the April market low, which is sort of that last major swing low for the S&P. From that moment, right, from late April to early July, you had the Magnificent Seven outpacing the NASDAQ 100, the S&P 500, and the, equal-weighted S&P 500. From early July to now late July, you can see that everything has been coming down, but look at how steep the pullback has been on those growth leadership names versus like the S&P. Still down, but a much smaller percentage. So what led on the way up, particularly the mega cap growth, is leading the way down. And the problem is there's so much market cap represented in this Magnificent Seven names. When they're down to the degree that we saw today, there's no hope that our major benchmarks are going to be anything but pretty ugly. Speaking of, if you like the color red, you're going to love today's heat map. This is our updated market carpet. I'm finding myself using this more and more. It's a beautifully designed visualization. And there's a lot of different color choices. I'm using what we call the vanilla color scheme, which means neutral is kind of this vanilla color, I guess, maybe a neutral beige kind of color. And what I like about that is it makes the bright green up stock stand out, makes the bright red down stock stand out as well. So this is a day when obviously the growth sectors were struggling. That's technology, communication, services, and consumer discretionary. Look at all the red in technology and note how the biggest boxes are in many ways the brightest red colors, right? So the stocks getting dinged the most are the ones that have been leading the most and certainly have become some of the largest names. And that is what made today such a painful session. But for a moment, ignore, sort of mentally tune out the upper left corner and focus on the rest of this. And you're going to find in sectors like healthcare, in utilities, in industrials, a lot of these got pulled down through the course of the day. But you can see in financials, certainly in consumer staples, you see quite a bit of green, and if not all, a lot of green, certainly some mixed results today. So just on one big down day, there were areas of the market that did just fine. And I think that's important to note. On a day when it feels like everything finished lower, focus on where there might be some areas of the market not going lower. And you'll see them today. Most utilities were up. Most healthcare stocks were up today. So there are areas of the market still showing strength. I would argue small caps still very much outperforming given the deterioration we see in the biggest names. But certainly this is a market that has felt weaker rather than stronger. Let's go to a daily chart of the S&P 500, just see how things played out. This day, with the sell-off that we experienced, not only broke down through that trend line, the one trend line to rule them all has now been violated. Now, as we mentioned, I think on yesterday's show, when you have a key trend line or any level of support or any sort of pattern, I think of it as in three phases. Number one is the setup phase, where you can draw the pattern and you can sort of agree that this is a great way of representing the trend. I think for the last month, we've been able to draw, and really for the last couple months, we've been able to draw this trend line using the major lows and recognize that we remain above that line. The trigger would be a confirmed close below that trend line, which we finally got today. This is the first time now we've closed below that key trend line. Next question would be follow through. Tomorrow, do you see further deterioration? Into Friday's session, do we see a sign that this was not just a one-off thing? A lot of times you'll have a one-day break and then immediately the next day a pop back higher. Getting a follow through, getting additional movement in this downside direction, I think would complete the rotation. We are very close to the 5,400 level, which I've talked about as being sort of the level, because that would be a break below the trend line, which we've now broken. We currently closed almost exactly to the penny at the 50-day moving average. So my question would be, does that hold through the remainder of this week? We're also just above the price gap that we set earlier in June. Are we able to hold that as well? If we are able to hold those levels, if we're able to hold 5,400 through this week, I don't think this market is looking too horrible just yet. But certainly we've had the initial salvo of weakness with today's move below that trend line support. The RSI is currently just above 40, by the way. I would keep an eye on that as well to see if we're able to hold, because if the RSI can hold 40, this can still be sort of labeled as generally constructive momentum. You're going to have pullbacks, and as long as the RSI holds 40, things still aren't that bad. We get below 40, all of a sudden it starts to look a lot more like deeper and more meaningful corrections than something just short term. So we're right at a pivotal moment. I would say the deterioration we've seen tells me we're not done yet. But again, the evidence is in price. I do want to briefly look at the NASDAQ, and we'll look at the QQQ just to sort of see what today's move has meant. Now, I have a weekly chart here. The daily chart, of course, looks about as ugly as you probably would assume. Today's drop actually brings the QQQ below its 50-day moving average for the first time since the April pullback. When we did break below there in April, we did for about another week further deteriorate down to around 410, 412. So that would tell us maybe we're not quite done. The RSI has gone below 40. So with growth leadership in the form of the QQQ, it actually looks a lot weaker just in the short term than we've seen from the S&P. The weekly chart is still fine. This is a weekly chart using trend lines from the early 23 low, from the late 23, October 23 low, the April 24 low, and that's actually not too far below current levels. So as long as we hold that, as long as we don't pull back too much further, I would say this is still within a great long-term uptrend. We start to get below, we'll call it 460, maybe a little bit below there, maybe 450 on the QQQ. That would be a violation of that trend line, in which I think you would have to admit is more of a deterioration than you probably want. The MACD, by the way, just very close to giving a key buy signal. Certainly looks like that's the case, but I like to update that sort of weekly pattern at the end of the week, which we are not there yet. Speaking of volatility, and that was a horrible transition, forgive me for that one. Let's look at the VIX, because the VIX has, as of today, again, I think today was a game changer in terms of finally, there have been concerns about, well, what if this happened? Well, what if we sell off? I think today is really sort of validating the fact that growth stocks are struggling, and certainly on a relative basis, unwinding their leadership dominance. We can see that the VIX today pushing above 18. That's after yesterday we got slightly below 15. Last 2 days, I think, have been slightly below 15. Today pushing right back up and around 18. So VIX over 15 to the degree that it is tells me we're in full-on pullback mode. That's the trend that I'm seeing. That's what I'm going to, I think, now assume that we're in a pullback until proven otherwise. You look for signs of accumulation. Signs of accumulation off of the April pullback were quite helpful. Look to see if we can mount some signs of stability. Worth noting that back in April, the VIX only got to 19, and that was it. VIX above 20, bit of a different game. All of a sudden that puts that in a list of more meaningful corrections. That's where deeper corrections have usually started, with the VIX popping above 20. So let's keep an eye on that level, not too far above current levels, by the way. In terms of breadth conditions, again, we've seen a lot of deterioration now going into the close. Earlier in the day, the breadth did not look that bad, but today now you're starting to see things unwind a little further. The S&P, as we noted, is right at its 50-day moving average. 59% of S&P stocks remain above their 50-day moving average. Not too much further downside. Another down day could immediately take that below 50%, and that's the level that I pay attention to. This indicator above 50% means most stocks are going up according to their relationship to their 50-day moving average. We break below 50%. While it doesn't guarantee a long and lasting corrective phase, it does tell you that whatever uptrend you're experiencing before now is probably not in play anymore. So I think keep an eye on this chart for sure. The long-term breadth, of course, still fine because most things are above their 200-day moving average. But if we would get further corrective moves, this sort of chart can help to differentiate short-term pullback sort of patterns with long-term reversal patterns, which would mean less than 50% of stocks above their 200-day. We're nowhere near that at this particular moment. I also want to highlight some of the sector movements. When we think about relative performance, I like to use these three charts. Here's the relative performance of your 3 growth sectors: technology rolling over in July, communication services trending downwards, the consumer discretionary sector over the last week now starting to rotate lower as well on a relative basis. Here are your 4 pure value sectors, as I would call them: industrials, financials, materials, and energy, all over the last couple of weeks starting to improve versus the S&P 500. Here's the concerning one, though: defensive sectors, utilities, consumer staples, and real estate, all on a relative basis over the last couple of weeks starting to improve. So this is one of those where the growth sectors are underperforming over the last couple of weeks. Everything else is starting to improve. And the improvement in defensives is what concerns me the most, because that's where investors often like to rotate when they're conditioned or trying to what's the word I'm looking for? Trying to cushion themselves, I guess, from further potential downside. And we're starting to see that play out here. To finish off today's recap of a lot of deterioration, there were some things actually doing okay today, and I just want to highlight some of those stocks actually managing to look strong in a weak market. Seagate Technologies in the technology sector is a hard drive maker. STX actually making a new 52-week high today, up about 4%. Again, charts like this are out there, and I think that's a reminder that even though it feels like everything went down, not everything. So on a day like today, it can be particularly helpful to look at the stocks that actually gained ground, not just on a relative basis, but on an absolute basis. What were the stocks that closed higher on a down day? Look at the top performers in the S&P. Those can tell you some of the things that are able to buck the larger trend of deterioration and actually make some headway to the upside. And when you own things that are actually going up in a down tape, boy, talk about the ability to outperform. Own things that are going up when everything else is going down. You're in great shape. STX was up about 4% today. Western Dig is the other one, kind of in a similar structure, not as good, down about 1.3%, not the end of the day, but Seagate definitely looking preferable to WDC if you just compare chart A to B. Really interesting way. By the way, do you know the trick to comparing those two? Here you go, right? Go to Gallery View. In the drop down, type the first ticker, comma, second ticker. This is sort of a hidden feature of Stockcharts. I love it. It uses the gallery view, which looks at different time frames, but AB, it's a great way to compare 2 different stocks on an apples-to-apples basis. Here's the daily chart of Seagate versus the daily chart of Western Digital. Here's the weekly chart of Seagate versus the weekly chart of Western Digital. We include the point and figure charts as well. Look at the bullish point and figure breakout that you see on STX versus more of the deterioration that we observed on Western Digital. Great way, by the way, to compare 2 different tickers. And there's a review. Go to Gallery View, type 1 ticker, comma, second ticker, and you can make that comparison. Bristol Myers is another one that actually finished higher today. We can see, again, not a great chart in terms of it's still below a declining 200-day moving average, but after in a bit of a consolidation between 40 to 42, we'll call it, actually making some headway and breaking out of that resistance range. I'd love to see a chart like this get above the 200-day. That's what it was unable to do here in March, right? Similar pattern where we were sideways for a couple months. We actually broke out of that range, but we're unable to get above that declining 200-day. That's why waiting and being patient for that final breakout can really help you to capitalize on the next move higher. So we'll see if Bristol Myers is able to get it done. AT&T, by the way, one of the best performers in the, that was not the ticker I wanted. That's Train Technologies, which went down. AT&T bouncing off of the 50-day moving average. Earnings name today up over 5%. This is a decent yield, over 5% dividend yield on a stock that's actually going up on an absolute basis. Compelling chart. And also some utilities, right? Here's NextEra, NEE. Here's Eversource, ES. Look at that, breaking out to an upside. Again, when you're looking at utilities or other stocks that are higher yielding, you want to put an underscore before the ticker. That'll look at the unadjusted data set, which looks at the pure price action instead of doing dividend adjustments. On a big dividend payer, I like to look at it on an absolute basis without the dividend adjustments. What you see here is a stock that actually has been able to gain above the 200-day moving average, which is just starting to slope higher, and that on a higher yielding name seems like an interesting place to be. All right, I've avoided it long enough. Tesla looks bad. It's gapped lower. We talked about that consolidation phase, what we call a pennant pattern that has now resolved to the downside. I think that is a a sign of further weakness to come in Tesla. It could certainly bottom here and rally in the next month, but more likely is that we start to test a moving average support. Maybe we get back into the range of the previous lows from the first half of the year. But overall, this earnings miss really resolves that chart to the downside in a way that tells me to be patient and look for signs of accumulation. I'm not seeing it yet. Alphabet below its 50-day moving average. We talked about up until today, it had held an ascending 50-day moving average, which is pretty encouraging. Today, down another 5%, RSI below 40. I think Alphabet and other leading names like this probably have further to go before we can find some stability. Again, we'll see. SMCI, you remember this one? At one point, just an incredible leading name, up around 1250 is where we peaked out in March. Now we're actually down to around 710, which is where we closed today. What concerns me is today another 3-month low, or very close to it. We're actually testing support around 700 from April and May. I don't like how this is looking. It's down another 9% today. And again, I think charts like this you want to avoid. One of two things could have happened when we were in this basing pattern. Either we resolved to the upside and break above 1,000. That never played out. Or we break below 750 and resolve to the downside. It appears that that is more what we're going to see. Semiconductors also showing weakness. Broadcom closing down another 7.5% below its 50-day moving average today. NVIDIA down about 7%. Closing below its 50-day moving average. We'll stop it here, and I would tell you, with a chart like NVIDIA, you don't have to look that far back to see a very similar setup to what we see today. Today, we closed below the 50-day moving average. That also happened in mid-April at the April market low. The RSI got down to around 35. We're currently around 41, 42, so still a little bit above here. Back here, we closed below the 50-day moving average for only a day, and then that was the end. We started to see buyers come in, push price higher. The momentum never really got to the oversold region, and we started to see improvement in momentum. We eventually saw improvement in relative strength as the stock was able to get back above its 50-day moving average. That's the ideal sort of optimistic playbook you could be expecting here. But what that also means is if we fail to find stability here, all of a sudden April is no longer the playbook, and we have to look at further deterioration as a much more likely outcome. I think this is the concerning development that today raises for some of these leading growth names, and indeed our benchmarks, which are very heavily geared towards these growth stocks, as we saw from the MarketCarpet earlier in today's show. Those stocks struggle, those big mega cap names, and it's tough to hold your ground as a growth-oriented benchmarks. Folks, that's our show. Thanks so much for joining us every weekday after the close. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great night.